The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody. This is Jennifer Schaus coming to you live from Washington, D.C. today, and thanks for joining us in our DFARS webinar series. We're obviously getting close to the end of the year, so we're winding down in the series. But before we dig in, just a quick blurb about us. We do provide professional services for federal contractors. This includes product, service, and software companies. We're industry agnostic, so A to Z and everything in between. Some of the services and products that we provide are a market analysis report, GSA schedule assistance, business development, proposal writing, and then just some of the other services you see here on your screen. You can find more information about us on our website, which is simply jenniferschaus.com. And now to tell you about the today's webinar series. It is complimentary. We started at the beginning of the year and we went sequentially through each part of the DFARS. Last year we covered every part of the FAR. These are all, again, complimentary and recorded. You can find the recordings on our YouTube channel, which now has almost 500 complimentary webinars, and you can also find these on our website as well. We put all the PowerPoints also on a public site, which is slideshare.net, and I believe today's PowerPoint is already up on SlideShare. Our speakers, as you guys probably know, if most of you have attended these webinars in the past, are attorneys, consultants, and SMEs in government contracting, and this series obviously covering defense contracting. So our webinar series is made possible through our sponsors, and we just want to give a shout out and thank our sponsors, who include, first and foremost, the Virginia PTAC, which is the Procurement Technical Assistance Center. They cover the entire state of Virginia, and they provide one-on-one mentoring, counseling, and training. You can jump onto their website to either sign up for the counseling, look at their training calendar, most of which are complimentary or priced at very, very small business friendly prices. If you've got questions or any other notes for the Virginia PTAC, you've got their email address as well as their phone number there. Their main headquarters is out of the George Mason University over in Fairfax, Virginia. Next up, we've got C3 Integrated Solutions. They are your go-to for CMMC, DFARS, and NIST 800-171 compliance. Contact information is in your lower right-hand corner, which is the info@c3isit.com, and you've got a phone number there as well, which will get you to a live human being. Workplan, they are your software provider for government contractors, helping you manage incurred cost submissions, DCAA compliance, contract management, and a lot of other services. Your contact there is Anita, and her phone number and email address are in the right-hand corner of your screen. These guys, as well as C3, are also advertisers in our newsletters. We want to thank them again for their participation. Federal Business Council, you guys probably know these folks very well, as they put on and curate the annual government procurement fair, which used to always be in April. I'm not sure what their schedule is these days, but they've got a lot of virtual and in-person events, so we want to thank our friends there. You've got contact information for David in the lower center part of your screen. And again, thanks to the Federal Business Council. GOV White Papers, sprung out of Gov Events. This is a portal or a database where organizations can post content and share information about government and government contracting. So GOV White Papers, we want to thank them. Your point of contact there is Donna Monday, and her contact information is in the top right-hand part of your screen. SWCTech, Eric Clark is your contact at SWCTech, and they also provide CMMC services. They've been a sponsor in some of our events and programs, and so we want to thank them for their advertising and sponsorship. And last but not least is Ocean 5 Strategies. They are your go-to for SEO, website design, for government contractors. Great group of people over there. Your point of contact is Chris Brinker. She can be reached at the email address in your lower right-hand corner of your screen. And okay, now we get to the good stuff here. Craig, thank you so much for joining us today. Craig Stetson joins us from Capital Edge. I'm going to stay on this slide and let you, Craig, say whatever you need to, and just let me know when you're ready for your next slide.
All right, thank you, Jennifer. Welcome everybody out there. We're here today to talk about termination of contracts. We're going to talk towards the end about DFARS, Part 249, but before we go there, we really need to talk about FAR Part 49. And, what is a termination, kind of what are the rights and responsibilities of the parties, and then we'll wrap up with some of the unique, the additive features, if you will, that are in the DFARS. So I'm Craig Stetson. I'm a partner with Capital Edge Consulting. Just real quickly, Capital Edge, national consulting firm that deals exclusively with government contractors. So we, advise a wide range of clients, from the very large name brand defense contractors down to smaller, middle market type companies. We deal in really all aspects of government contracting, from contract setup, business systems, cost allowability, cost allocation, terminations, REAs, cost accounting standards, so on and so forth. Probably 50 or so professionals scattered around the country. So anyway, thanks again, Jennifer. Look forward to discussing terminations. And next slide. Okay. So our agenda: termination for convenience. This is FAR Part 49 stuff here. So as I'm sure everyone's aware, the supplements, the agency supplements, in this case, the DoD supplement, the DFARS, is an additive thing to the FAR. So the FAR is the baseline regulations that apply really to all agencies. And then each agency is special, so they have to have their own supplements. And the provisions or the requirements in those supplements are additive to the FAR. So we need to start with the FAR here to have an overall understanding or framework of how terminations work, and then we'll wrap it up with what some of the provisions in the DFARS are relative to terminations. There's not a lot in DFARS Part 249, so we'll talk about, it's really more notification requirements that the contractor is obligated to do when contracts are terminated. So we'll wrap up with that. So termination for convenience, historical context, some of the contractual provisions, and who some of the key players are along the way on the government side and on the contractor side. Prime contractor requirements once you get notice of a termination, and then the settlement process to be able to submit a proposal. A termination settlement proposal is what it's known as, to the government to get paid for unpaid costs, at the point of the termination, or costs that will continue after the termination. We'll talk about what some kind of leading practices are to achieve a successful outcome, to reduce or mitigate risk, from a compliance or reimbursement standpoint. And then, like I said, we'll wrap up with, the DFARS Part 249 provisions. Next. So historical context, terminations for convenience. There's two types of termination. We're going to talk about convenience today, but there's also default, termination for default. That's a bad thing. You don't want that. The government, can terminate a contract for default, basically, if you're not doing what you're supposed to be doing under the terms of the contract. If you're not, delivering on schedule, or you're doing something else, you're not meeting your obligations, the government can terminate for default. That's it's a bad thing. It's an expensive thing. So we'll just kind of leave it at that. But certainly the much more popular or frequent way to go is termination for convenience. This is something that's unique to government contracts. The government, as the sovereign, really has the right, really needs that ability to be able to terminate a contract for their own convenience. It's different than a commercial contract situation. The remedies are certainly different in the government contracting world, but it is something to be aware of, and it does happen, periodically. And we'll talk about here in a minute, some of my own experiences and situations, dealing with terminations and the reasons therefore. So termination can be one of two things, either complete or partial. By that I mean if your contract was originally to sell 10 tanks and you start performance, the government can come in there and terminate the entire 10, or they can just do a partial termination and terminate, let's say 4. Therefore, you're only obligated then to continue with 6. So the termination notification letter that you get from the government will clearly tell you which type it is, either complete or partial. And some of the reasons, requirements changes, all right? The government's requirements change. Bid protest. A lot of times the unsuccessful offeror will submit a bid protest, and depending on the outcome of that protest in front of the GAO, for example, the government may terminate the contract as awarded and then just start over again, do basically a recompete. Really depends on what the outcome of the bid protest was. Government runs out of money, funding issues. The NDAA is the National Defense Authorization Act is an annual thing where in part the government will designate certain programs for defunding, and that's going to result or may result in a termination, either complete or partial. Technology changes, things change over time, and the government may not want the technology currently contracted for, may want something better, quicker, faster, whatever the case may be. Changes in wartime things, for example, or just other events. I'll give you an example. Right now, I have a client that I'm dealing with on the East Coast, had a contract to deliver, aircraft type stuff to the Afghan Air Force. Well, the government of Afghanistan collapsed recently and was, taken over by others. So the government, and I've written a few papers on this actually, but I mean, the risk then was that the U.S. government now, they're not selling to the Afghan government because the Afghan government as it existed then does not exist today. So certainly that's a change in requirements. So my client's contract was terminated last month, termination for convenience, simply because there is no more Afghan government. There's the Taliban, and that's, certainly a different situation. Other things may end early. You go into a country for an event and, that action, completes a lot quicker than what was anticipated. So existing contracts are no longer required. So the requirements have changed and the contracts are terminated. The government has wide discretion in terminating a contract for convenience, but generally it must be in good faith. They cannot just terminate a contract simply because they want to or they don't like you. There needs to be a legitimate reason made in good faith, but still, nevertheless, a rather wide discretion on their part to terminate contracts. Next. So termination clauses have been around forever, going back to the Civil War. The second bullet there, like I just said, wartime type events and contracts supporting wartime initiatives. The war ended. We don't need it anymore. So the government needed a mechanism in the contract to be able to, stop work under those contracts simply because there's no longer a need. There's no longer a requirement. We talked about whole or in part. That's the complete or partial termination. And the government agrees to pay reasonable allocable cost plus profit on your uncompleted or undelivered work. Okay, we'll talk a little bit more about what that means here shortly. Next. So FAR Part 49, its own section, own chapter in the Federal Acquisition Regulation that deals with terminations for convenience, all right? Reasonable reason for the termination, reasonable good faith reason to terminate the contract. The second bullet is important. Government's termination objective is to make a contractor whole, All right. So the government realizes that, terminating a contract is not a normal thing. Certainly wasn't something anticipated. And the result of terminating a contract, depending on the complexity or the size of the contract compared to the contractor's overall business, can have a significant effect on a contractor, financially, employment-wise. A lot of times a large termination will result in having to lay off people. Obviously, it's kind of a big thing. So the intent is to make contractors whole because of the government's actions. On the other hand, it's not a mechanism for contractors to get whole. If the contract was going to be in a loss position, for example, had it not been terminated, then the government was going to want to know that when settling the termination, and your costs may be decremented accordingly to put you back into the position you would have been. So it works both ways, on the objective to make you whole. The contractor can't use it as a means to get whole if they were otherwise going to be in a loss position. Contractor allowed to recover various types of costs and profit or fee. Okay, allowable costs incurred in the performance of the work. So it's important to, your contract is maybe halfway through performance, and it's for 100 widgets. And at the time of the termination, 40 of the widgets were completed and delivered. Something, less than the 60 remaining were in process, and so many weren't started at all. So from an accounting perspective, we need to be able to go in and parse out those costs related to the work in progress. That is the unfinished, uncompleted, undelivered stuff. That's really what you're subject to, or you're entitled to reimbursement for. You're not entitled to cost. The cost associated with the 40 widgets that were delivered and accepted is not relevant because you've been paid the contract price for those 40 items. So it's really the cost incurred related to the WIP that you're entitled to, with a reasonable profit or fee, depending fixed price or cost reimbursement, on top of those costs. Terminations are unique. They can cause, non-recurring or extraordinary type of events to arise, idle facilities. You have a contract, a large production contract. Well, now it's gone, and that consumed a significant portion of my production capacity or my facilities. So now they're sitting idle. So I've got costs there associated with that. Severance pay. Okay, we may have to lay people off. Severance pay is an allowable thing in termination of contracts. Storage costs, settlement expenses. Settlement expenses are the costs incurred to settle the termination, to prepare the proposal, to go out and count all the inventory that you need to now keep track of and put on a form and submit to the government and have them come in and inspect it, et cetera. It's accounting time, consultants, lawyers, whatever it takes to prepare the settlement, submit it to the government, and negotiate an outcome. All of that fits the definition of settlement expenses. Those, as long as they are reasonable, reasonable is one of those terms that has a different definition or meaning for everyone. So as long as they're reasonable, they're reimbursable. Basically converts a fixed price contract to cost reimbursement. So when your fixed price contract is terminated, for termination settlement purposes, you really need to go in and identify actual cost incurred. So just like under a cost reimbursement contract, you're going to bill for your actual cost incurred, actual indirect expense rates, all that jazz. So in a termination of a fixed price contract, it gets converted over to a cost reimbursement type settlement. So the accounting system needs to be accurate and adequate enough to be able to capture, accumulate, allocate, et cetera, costs on an actual basis. Next slide. Here's some of the clauses, or the the FAR part, DFARS part sections that are relevant. So there's various termination clauses there: 249, 1, 2, 4, 6. What's interesting here, it's not on the slide, but there's a thing out there in government contracting a legal doctrine. It's called the Christian doctrine, which allows clauses that are otherwise not physically included or referred to in the contract to be read into the contract as if they were there anyway. So there is not a list per se of those types of clauses that fall under the Christian doctrine, but termination for convenience is one of those clauses. So the fact that you don't have the clause in the contract does not prohibit the government from terminating it nonetheless. So the clause would be read into the contract. All right. Commercial items, FAR Part 12. I did one of those recently for a client. There is a termination for convenience provision in the overall commercial items clause 52212-4. There's a slide on the settlement process there for commercial items. It's much simpler than a termination under FAR Part 49. Next. So the key players on the government side, you got the contracting officer. That's going to be the person that notifies you of the termination. You'll get a letter, termination notification, and it's usually, I don't know, a 3 or 4 page letter that says contract is terminated, effective immediately. And then it gives you a list of instructions which come right out of FAR Part 49. Number 1, top of the list is stop work immediately, do nothing more, notify your subs, and then so on and so forth. The TCO, Termination Contracting Officer, that is the contracting officer on the government side that is responsible for settling the contract. So once the contract is terminated, they will then notify you of who the TCO is. I mean, sometimes it's rare, I think, but sometimes I've seen, the PCO handle the termination, but generally you're going to get a TCO, a person that is designated to settle the terminated contract. That's who you're going to communicate with up front. That's who you're going to submit the settlement forms to. That's who you're going to submit the settlement proposals received from your subcontractors to for ratification. So that is your day-to-day contact during the settlement process. Prime contractor and subcontractor. If you're a sub and you get notification from the prime, then you have to deal with the prime. There is no privity between the sub and the government, so you have to deal on a termination with your prime contractor. The prime contractor should basically, copy what they received in the way of instruction from the government and just simply communicate that back down to the subcontractor as to what to do upon notice of termination. Next. So what do you do when you get this notification? Well, like I just said, you stop work immediately on the terminated portion of the contract. So if it's a complete termination, you stop work, you're done. If it's a partial termination, you stop work on what was terminated and continue work on what wasn't. Terminate all the subcontracts. All right, that's important. Okay, terminate the subcontracts, give them the same instructions. Advise the TCO if there's anything special going on, any, non-recurring or unusual type of costs that are going to arise because of the termination. It's always good to tell the government that up front rather than, a surprise down the road when you submit the proposal. Continue on the, continue performance on the continued portion of the contract. Equitable adjustments. So if because of the partial termination, it's going to cost me more now to continue work on the uncompleted or the unterminated items, you're entitled to submit an REA for those additional costs. Okay. It's going to cost me more now per unit to complete the unterminated units than it would have had the contract not been terminated. Well, that wasn't anticipated when I negotiated the contract to begin with. You, government, changed the scope of the contract by terminating a portion of it. Therefore, I'm entitled to seek relief in the way of cost or schedule or both under the changes clause and under the termination clause as well. So equitable adjustment on the remaining portion of a partially terminated contract. Property. I don't know what happened to the font there at that last line, but it's a lot smaller. Anyway, if you're making something and you have parts and inventory and stuff like that sitting out there, you got to preserve that. You got to segregate it, count it, because it all goes on a separate form as part of the termination settlement. I mean, it's government property, so you're obligated. You have a duty to protect, preserve, segregate it, take care of it, wrap it up, put it away, etc. And that's a whole different thing. That there are property, DCMA property people that will come out to look at the inventory. They will then give you instruction what to do with the inventory. You can either give it to the government. They may direct you to just scrap it, sell it, do what you like, or you can offer to buy it, from the government too. But again, you'll get instruction, or should get instruction, from the property person on what the disposition is going to be for this property that's sitting there as a result of the termination. Next. More things that the prime contractor has to do. Notify the TCO in writing if there's any legal proceedings between you and any of your vendors or subcontractors. Settle outstanding liabilities and proposals. Okay, so I said earlier that it is the prime's responsibility to settle with the sub. And the way that works is the subcontractor prepares their settlement proposal, they submit it to the prime. The prime is then supposed to review that proposal, see if it's adequate, see if it's in conformance with applicable requirements, and then forward it on to the government for ratification. All right, so prime does its thing, reviews the proposal, sends it to the government, to the TCO. The TCO will then inform you if they ratify or agree or approve of the settlement proposal with the sub. That would then authorize you to go pay the sub. That then gets included and incorporated in the prime contractor's proposal to the government. So when does all this need to be done? The standard termination for convenience clause says 1 year. So 365 days from the notice of termination to submit your settlement proposal. Okay, you have 1 year to submit the settlement proposal. It's generally recommended that in a prime sub relationship, you move that up to 6 months. That then gives the prime the second 6 months of the year to be able to review, review the sub's proposal, submit it to the government, get the ratification. So you want to back up the timing requirement for submission from the sub, so that it gives the prime time to review it and get it approved, so that it can then be incorporated in the prime's proposal, which is due within 1 year. Inventory, there's a timeline on that as well. Disposition, 120 days. So a couple of different dates there to be aware of, and timing schedule requirements. Next. Termination settlement proposal, okay, will be looked at by various parties. The PCO, I mentioned that earlier. The TCO, I mentioned that. The DCAA, Defense Contract Audit Agency, they are the ones that are going to audit the termination, assuming this is, a DOD transaction. So the DCAA is going to look at that or audit that proposal. Plant clearance. That is the DCMA people that I was referring to earlier on the property, plant clearance. They're the ones that will come out, look at the inventory, tell you what to do with it, give you instruction, etc. So various parties, both on the DCMA and the DCAA side, will be involved somewhere along the way with your settlement proposal. Next. So what does this proposal look like? Like most things, or a lot of things anyway, in government contracting, documentation is big. It's important. So background and entitlement. So with any kind of a claim, an REA, and a termination, it really boils down to two things. It's entitlement and quantum. So entitlement, what does that mean? It means I'm entitled because of what you did to me. This was clearly a change in scope, So we would want to describe what our entitlement there is, what the government did, what authority we are, submitting this proposal under, and it's usually a contract clause that you reference. So just basic background information. What was the nature of the contract? What were the requirements? Where were we at the point of termination? What was left to do had it not been terminated? Any other, effects on the facility, on the employees, on the supply chain? All of that should be described, clearly in the proposal, just to establish, all right, here's the deal. Okay, here's what we contracted to do, and here's, as a result of this termination, really, the consequences. It kind of lays the framework of what we're going to be claiming and why. So a good solid description, explanation, whatever you want to call it, of the entitlement is important. And then second from there, the quantum, the cost impact. All right. So first we need to establish the framework as to why we believe here's how we've been harmed. Here's the cost impacts. Here's the things you did to me that were unexpected, certainly weren't negotiated in the contract. And then the cost accounting can just follow that. All right. And price each event or each of those situations that were caused by the termination. Should be, from a quantum point of view, calculated separately on a discrete item basis is the preferred method. So contract information, fixed price or flexible, commercial, negotiated. I mentioned these already. What work was remaining, that's, in the overall description, the background, current status of the contract at the point of termination. Partial versus complete, we talked about that. Resources affected. Property, all right? Property can be not a problem, but just from depending on the contract, if it's a large production contract and there's a lot of material and purchase parts and assemblies sitting around, all that's got to be, counted, and it's got to be cataloged. It's got to be put on a form and submitted to the government. So there's a lot to that, or there can be. Just administering the property, and like I said earlier, preserving it, protecting it, et cetera. So that's something that can be a challenge. Next. So the cost proposal, introduction proposal, we'll talk here in a minute about the standard forms. When you do terminations, there are some standard forms that are required. And then, documentation of your cost. Where did the number come from? And remember, this is now actual cost that we're doing. Does that mean every dollar has to be actual, that you can't do estimates or that you can't make assumptions? No, it doesn't mean that, but there needs to be a legitimate basis for where those estimates or assumptions came from and why they would need to be or should be disclosed as you're, supporting the buildup of your cost. And it's all cost of production, for the uncompleted items. So you got labor, material, other direct cost, your indirect expenses, overhead and G&A, any subs. So basically just a cost element breakdown of what was incurred and not paid for at the time of the termination. Okay. You got to certify it if it's over 2 million. That's a TINA certification there. That fourth bullet, certified cost or pricing data if the settlement exceeds $2 million. Next. 2 methods. Inventory basis, total cost basis. Inventory basis is preferred. All right, there is an error in that second little sub-bullet, first sub-bullet there. Inventory basis, typically used in construction, manufacturing, service contracts with unit pricing. The construction type contract is wrong. That should be down in total cost. So inventory basis, that's just like the name says, your settlement proposal is based on the inventory. And your inventory takes different forms that needs to be identified during the process. So by different forms, I mean you've got raw material, you got purchased parts, you got subassemblies. So it's important to the government when the plant clearance guy shows up that this inventory is put in the right bucket, the right description. And there's a column on the form, the standard form where the inventory is listed that designates the inventory or the property among those different classifications. Total cost, that's acceptable as well. I believe you need approval from the TCO ahead of time to use that method, but that would apply in situations where your accounting system does not capture cost at the unit level. It's just simply at the contract level. Construction contracts, I think, are required to use the total cost basis. Okay. So two different inventory methods, or two different settlement methods, excuse me, and two different forms, the SF 1435, the SF 1436. So SF is standard form. They're out there, GSA website. You get these forms, and those are required for submission to the government. Okay, next. Here's the different forms and where they apply. 1439, that's a schedule of accounting information. That's really just a description of various cost accounting practices that were used to develop the settlement proposal. Partial payment, you can attach or submit with your initial settlement a request for partial payment, pending the settlement. And these can take a while. They do take a while. They can take years to settle some of these bigger terminations. And then your inventory schedules, okay? Inventory Schedule B, Inventory Schedule E. These are different schedules used to list all of the parts, the material that's sitting there in the shop that the government's going to come and do their plant clearance thing. 31205-42, there is its own cost principle on termination costs. Okay, what's allowable, what's not, what the process is to recover cost. So another important thing to be aware of is the cost principle related to terminations. Next. Performance costs, okay? These are the costs related to the undelivered, uncompleted items, unfinished. Metals, raw material, purchase parts, okay? I just mentioned that. That's the breakdown of the inventory by type. Miscellaneous inventory, work in process, tooling, other costs, G&A, that's basically the cost element breakdown to come up with your total cost of the uncompleted items. Similar situation on the 1436 for total cost. It's just we don't break it all down to that level of specificity. Common items, that's a term unique to terminations. The government requires if you have common items, meaning inventory or parts sitting out on the floor that are common to other contracts, then you're supposed, in a way to mitigate the cost to the government, divert or transfer those common items and use them on other contracts rather than claiming them for reimbursement on the terminated contract. So you got stuff sitting in inventory on the balance sheet. You got nuts and bolts and metal and stuff like that that can really be used on multiple contracts. Then you're supposed to identify the common items, pull them out, and use them elsewhere, not claim them here. Unless, of course, the quantity on hand of the common items is in excess of what you're going to use elsewhere in your under other contracts, then you can claim it under the terminated contract. Cost principles apply. So I said earlier a few times that fixed price contract gets converted to cost reimbursement. Well, that also means that those costs that the actual costs that you're claiming need to be allowable in accordance with FAR Part 31. So the cost principles do apply. Finished versus unfinished, that's completed items versus uncompleted items. Remember, the cost incurred related to the finished items is not relevant for termination settlement purposes. We want to just to be able to parse out or to estimate what the costs incurred are related to the unfinished items. Next. We talked about this, it's prime contractor's responsibility to settle and deal with the subs. The prime's failure to include the clause, the termination clause in the sub, does not mean that the government will pay increased cost simply because the clause was not included. That's the third bullet. Failure to include appropriate clauses will not increase government's obligation beyond what it would have been had the clause been included. So it's important to be able to, or it's important to flow down the appropriate clauses to your subcontractors. You don't want to get in a situation where you're fighting with the sub because you failed to put the clause in the contract, and now you're really entitled, or they're entitled to a different payment scheme than the prime would be. So all that says is if you fail to do that and you cannot agree with your subcontractor on costs incurred under the rules of termination for convenience, the government's not obligated to pay that additional cost. Okay. This is the whole subcontractor submits proposal to the prime then reviews it, submits it on to the government for ratification. So point here is it's the prime's responsibility to review the sub. Next. Some unique or non-recurring items that arise because of the termination. We talked about some of these already. You may have unexpired leases or idle facilities. You got to return the plant to its original condition. Obsolete equipment. I got this equipment now that was bought only for this contract. I'm never going to use it again. So, I mean, it's obsolete. Unamortized initial costs. Let's say you've got, tooling or non-recurring engineering that was incurred up front. And the idea is or was that those costs would have been amortized over all units. Well, now all the units or some of the units have been terminated. So that's an example of where my per unit cost or price for the unterminated units is going to go up, and I can submit an REA to seek recovery because I can't recover all my unamortized costs now because the total units have changed. Severance or idle time. So depending on the size of the contract, and I've had over time several instances where the termination was significant enough to the contractor where they had to lay off a lot of people, and along with that comes a package offered from the contractor to the employee. Those are direct costs to the termination and should be included in the settlement proposal. Special local labor employment requirements. I've run into this a few times where this is local labor means overseas. So you have, a contract in Afghanistan, for example, or Iraq, to go in and do something. And a lot of the labor force are locals, either third country nationals or local nationals. Well, in some of those places, there are unique labor laws that, if you're going to retain local labor, then you're obligated to pay them, for a year, for example. So if the contract is terminated in 6 months, you still got to pay the guy, under the terms of the local labor laws. So things like that, would be certainly a unique or non-recurring item that should be included in the proposal. Reasonable good faith attempts, to mitigate cost. That goes, into your narrative proposal where you're talking about entitlement and your quantum. You would want to make sure that you include things that you've done as a contractor, things you've done, prudently to try to mitigate, reduce the overall cost to the government. Unabsorbed overhead, that's a thing only for the REA on the partially terminated contracts. Unabsorbed overhead is not a recoverable thing through the termination, it needs to be done through the REA. Next. Settlement expenses, we talked about that, generally allowable if reasonable, okay, and there's some examples, but it's basically the effort to to prepare your proposal, to deal with your subs, to do your inventory, all that stuff related to preparing, submitting, and negotiating your settlement. That includes internal and external cost. Internal cost are your own people. It's perfectly acceptable to take what is normally an indirect function that is performing the settlement activities and charge that function or that person as direct. So let's say you have some accountants and some contracts people and some finance people that are 100% G&A in the everyday world, right? But now they're working directly on this termination settlement. It is perfectly acceptable to take that time and reclassify it and make it direct, make it part of the settlement of the contract. So to do that, you need to be able to, you should set up, a charge number to begin with to capture time discreetly. That's an important thing. So instead of just charging the G&A number like you do every other day, there'd be a separate number set up specifically for settlement of this contract, capture that time so that it's supportable and auditable. You can show the auditor, what the actual hours incurred were. Next. Profit or fee, all right? Profit or fee. Profit on fixed price, fee on cost reimbursement. Government's going to look, that second to the last bullet there, estimate to complete. They're going to require an ETC be developed so they can see what the EAC would have been. All right, actual cost at the point of termination plus the ETC equals the EAC. And if that EAC is greater than the contract price, then obviously a loss would have been anticipated. So the government will take that information and likely propose a decrement, a reduction to your actual cost to get you back to where you would have been had the contract not been terminated. Remember I said early on here at the beginning that you can't take the termination as a contractor as a means to get whole when you otherwise would not have been. And that's what that means right there. So profit, I mean, it's a negotiable thing. There's a lot of things. There's a few items here where profit is not, it's allowable on your cost. It's not allowable on settlement expenses. It's not allowable on undelivered subcontractor goods or services. Anticipatory profits, not allowable. So it's really profit based on or applied to your cost incurred to do the undelivered items. And like I said, it's a negotiable thing. What would have the profit been is a factor to look at. We anticipated had it not been terminated, we would have realized a 10% profit. Okay, that's one data point. We performed all the high risk or the more difficult work up front, and then you terminated us. So that's another factor to look at. The complexity of the work I did is weighted towards a higher profit or maybe a higher risk situation. So there's other factors, non-numerical, if you will, factors to consider in negotiating what is a reasonable profit. Same thing with the cost reimbursement fee, the fee piece. Okay, next. Commercial items, FAR Part 12. I did one of these a year ago, a large vehicle manufacturer, made armored vehicles for the government. Anyway, it's very simple. There is no forms, no standard forms. It's really just a couple of spreadsheets and some narrative, and it's based on percent of completion. So government awards me $1 million contract. At the point of termination, I believe I was 70% complete. So the termination is percent of completion times contract price. So 70% times $1 million, 700,000 minus prior payments received. That's it, plus your settlement expenses. So it's a much simpler, much more accelerated process to do termination of commercial contracts. Cost principles do not apply. You look in that clause, 52212-4 specifically says the government has no audit rights. So cost incurred, not relevant, all right? Simply contract price times percent of completion plus settlement expenses. Simple process, simpler. Next. Okay, some kind of common sense things here. You know, what can we do to enhance the outcome here? Initial meeting with the TCO. All right, we want to sit down with the TCO and have this initial meeting, especially on the bigger, more complex programs where the likelihood that you're going to see some of those unique or non-recurring events arise increases. I'm going to have to lay off. I'm going to have to fire everybody. Okay, that's a big deal. Okay, government should know that up front so that they have a reasonable expectation of what's to come. All right. So communication, early and frequent communication, document the communication, have a record of what you said to who and when. Effectively manage subcontracts. We talked about that. There's the approval or ratification. Mitigate cost. We mentioned that. Internal charge numbers. Termination inventory. Okay. You gotta protect it. Okay. Seek disposal opportunities. Let the government know that, you know, there's things you can do to mitigate the cost. You can sell it. You can scrap it. The government's entitled to the proceeds from that, but still it's a cheaper alternative than just simply claiming the full amount. Again, that's if the government doesn't want it. So you've got to document what the disposition instructions or arrangements between the parties is or was. Periodic communication throughout the settlement process, and then timely submission of interim settlement proposal. All right. So documentation, communication, good cost accounting, discrete cost accounting, you know, kind of basic things when you're in a claim termination REA situation. Next. All right, the end. DFARS 249. There's a few clauses that go with this, but really this is just, it's notification, okay? The first one's not special termination costs. There's a clause in the contract where contractors obligated to, on large contracts, you know, 2 years or more, and then the numbers you see there. There's a number. You estimate what the special termination costs are going to be in the event of a termination. The special termination costs are all of the things that we just, you know, talked about. It's settlement expenses, it's severance, it's you know, the non-recurring, ongoing, unique costs after the termination. So the contractor makes an estimate of that and includes it in the contract. Canadian Commercial Corporation, the CCC, if, you know, there's a contract there with the U.S. government, it gets terminated. It's similar to the process we just described. There's a few other notification requirements that go with it, but for the most part, it's very similar to a situation here. Congressional notification. So significant contract termination involving 100 or more employees. There's a process where Congress is supposed to be notified of a termination. Notification of anticipated termination, that's, you know, worker adjustment retraining, you know, like kind of thing where contractor is required to notify employees of a pending, you know, termination, you know, or reduction. That is significant. It's major defense programs. There's a definition out there. It's a USC, you know, United States Code thing, but it's large contracts. So you know, when the termination is known or it's anticipated, you're required to give your employees notice. So that then gives them the ability to go out and, you know, look for something else to be retrained. Like I said, it's WARN, W-A-R-N Act like provision. So notification to employees. Other than that, termination of contracts is really, it's governed by, for the most part, FAR Part 49. The DFARS Part 249 is really here. Like I said earlier, there's really not a lot of additive stuff in the DFARS relative to terminations. So the first place to look at is FAR Part 49. And I believe that's it.
Okay, Craig, thank you. Yep. Craig, thank you so much for a fantastic presentation, very detailed and obviously relevant information. If anybody has questions about today's content, please contact Craig directly. You've got his email address here on your screen, as well as his phone number. He's on the West Coast, so just be cognizant of the time, although it sounds like you're traveling quite a bit, and probably in a couple different time zones throughout the week. Next week, we will cover the next part of the FAR, and thanks everybody for joining us today. This session has been recorded. It'll be on our website and on our YouTube channel, usually within about 24 hours. So thanks again, everybody, and thanks again, Craig, for taking the time to put together these slides and then sharing your time with us today.
Thanks, Jennifer. Thanks, everybody out there. And goodbye.
Okay, thank you.